Hello everyone, I am Professor Pallavi Devkate welcomes you in next lecture of Econ 242. Course title is Agricultural Finance and Cooperation. In previous lecture, we learn about credit analysis, in which 3 R's of credit and 5 C's of credit analysis we already learned. In today's lecture, we are going to learn about 7 P's of credit analysis. Okay, so these 7 P's of credit analysis are the combination of 5 C's and 3 R's of credit. Okay, so it is the advanced version of 5 C's and 3 R's of credit. So these 7 P's are: first one, principle of productive purpose, principle of personality, principle of productivity, principle of phased disbursement, principle of proper utilization, principle of payment, and last one, that is principle of protection. Okay, so we see one by one these 7 principles. In that first one, that is principle of productive purpose. Okay, so this principle of productive purpose, in short, it shows the whatever the credit which is borrowed by the bank, that credit must be used for productive purpose only. That means avoid the use of credit for consumption purpose, because if credit is used for consumption purpose, the crop loan or any type of loan that does not generate sufficient amount of income and which fails the repayment of that particular loan. Okay, so whatever the loan which must be used for productive purpose only, that means this loan which used to generate additional income from this productive asset, and then and only this loan generate the income, and this income can be used for repayment of that particular loan. Okay, this is the first P, that is productive purpose. Okay, after that, second P, that is principle of personality. So this personality principle, it is nearly related with first C of, that is character. So whatever the characters of that particular borrower, like honesty, integrity, trustworthiness, etc., can affect the credit worthiness of that particular farmer. Okay, so this principle of personality, it is related with character of that particular farmer borrower. Okay, moreover, the growth and progress of lending institution have dependent on major influencing factors like personality of that particular borrower. Hence, the personality of borrower and the growth of financial institutions are positively correlated. This is the second P, that is principle of personality. After that, next one, third P, that is principle of productivity. So whatever the credit which is used to produce the income, that means in combination of other resources, the credit can be used and which increases the productivity of that particular loan. Okay, so this principle underlines that the credit is not just the mean for increasing production from the enterprise, but also it should be able to increase the productivity of other factors which are employed in that particular enterprise. That means whatever the other factors of production used in production process, the productivity of that particular factors of production can be increased with the use of this credit. For example, use of high yielding varieties with fertilizers, chemicals can increase the productivity of other factors of production. Okay, so this principle emphasizes on making the resource as productive as possible by the selection of most appropriate enterprise. Okay, this is the next principle, that is principle of productivity. After that, fourth principle, that is principle of phase disbursement. So this phase disbursement is nothing but the distribution of loan according to different stages of requirement. Okay, whatever the loan, that means in case of long term loan, this phase disbursement is most important. In case of crop loan, there is no such type of phase disbursement. So this principle underline the loan amount needs to be distributed in phases so as to make productive use. Okay, at the same time the banker can sure about the proper end use of that particular borrower fund. Okay, for example, loan for digging of well, the phased disbursement of loan amount fits for taking up the cultivation of perennial practices. Then investment activities overcome the diversion of fund for unproductive purpose. That means whatever the fund which is given by the bank, this bank distribute this fund throughout the production process. Okay, to avoid the unproductive use of that particular loan. Okay, this is the fourth principle, that is phase disbursement. After that, fifth principle, that is principle of proper utilization. Okay, so this proper utilization implies that the borrower fund are to be utilized for the purpose for which the amount has to be lent. That means for which purpose the loan have to be borrowed, that and that only the loan must be used. That means avoid the use of loan other than whatever the reason. Okay, it is depend on the situation prevailing in the rural areas, like the resources, seeds, fertilizer, pesticide, etc. Okay, so whatever the loan, the proper utilization of fund is possible if there is exists suitable condition of investment. Okay, so this principle shows that whatever the loan borrowed from any purpose, the loan must be used for that purpose only. Okay, this is the another principle, that is principle of proper utilization. After that, next principle, that is principle of payment. So this payment principle, it is related with repayment of that particular loan amount. Okay, so under this principle, the fixing the repayment schedule of loan advanced by the institutional or financing agencies for investment credit, advance to irrigation structure, tractor, etc. The annual repayment plans are fixed over the number of years based on incremental return that are supposed to be obtained after deducting the consumption needs of the farmer. Okay, that means whatever the income of that particular loan, according to that income, the farmer must prepare the repayment schedule to repay that particular loan amount. Okay, this is the another principle, that is principle of payment. Okay, then next principle, that is principle of protection. So under this principle, the unforeseen natural calamities are there, or some unforeseen contingencies are there. So farmer fails to such unforeseen calamities or situation, and to withstand such a risk or unforeseen calamities, farmer take the some protection like crop insurance, then linking credit with marketing, provision of finance on production of warehouse receipt, etc. Okay, so this principle a resort to safety measure while advancing loan, like insurance coverage, credit linking with marketing, provision of finance on production of warehouse receipt, etc. Okay, also taking securities, bank advance the loans either by hypothecation or mortgage of assets, then credit guarantees when banks fails to recover the loan advance to the weaker section, the Deposit Insurance Guarantee Corporation of India reimburse that particular loan amount to the lending institution on behalf of borrower. Okay, so this is the last principle, that is principle of protection. Okay, so this is all about today's lecture, that is 7 P's of credit analysis. Okay, the question may be asked on this topic, like explain 7 P's of credit analysis, etc. Okay. Thank you all.